Hello guys, welcome to another developer video. Today I take an in-depth look at NVIDIA Corporation and Salesforce, both reporting earnings today. First we'll start with NVIDIA because of course everyone wants to know about NVIDIA. It's the most talked about company these days. And we'll just start with the business metrics. First of all, their balance sheet is the first thing that stands out to me. It is astonishingly good. Look, their current ratio is 4.17, which means that their short-term liquidity is insanely good. I think this is actually the best current ratio I've ever seen in my life. So I think that says a lot. The return on invested capital is 51%, which is insane. Return on equity is 69%, and return on tangible assets is 49%. Now, their valuation is 50 times earnings and 1.8% free cash flow yield. Both are high valuations, but not insanely high. Uh, Grant's valuation, I put in the 2025 estimated price per estimated earnings per share, and we got an intrinsic valuation of $69.23. The discounted cash flow model, we did 20%. I did 20% growth rate for the next 9 years with a 2% perpetual and an 8% discount rate. Now, I know some people will say that the perpetual is a bit low, but I mean, 20% growth rate on CAGRs for 9 years is insane. I mean, that this is a 4x of free cash flow. And also, this supposes a scenario where their free cash flow continues to grow and there is no negative catalyst, so to say. So, a world where NVIDIA isn't a cyclical company anymore, is a continuous company, so to say. And I don't think this will happen because their business is cyclical, as you well know, but because people believe this is such a great stock, I just placed in 20% growth rate for 9 years and a low discount rate, and I put in 2% perpetual growth rate because this is what I put in all companies. You never put more because then the valuations get absurd. So using these assumptions, we get a DCF price per share of $61.69. Now, let's do historical multiples. As you can see, their historical multiple is 49. So 49 trailing 12 month. They're 47. So pretty close to their TTM price to earnings. Multiples valuation, I compared them to AMD because I believe AMD is comparable, at least in a way, because they both sell GPUs. There really are not many reference companies or benchmark companies. AMD is really the only one. AMD has double the price to earnings of NVIDIA, so they're considerably more overvalued. The DDM, we can ignore it because I don't think they care about the dividends. Uh, yeah, so we'll just remove the DDM. And using the average of discounted cash flow for multiples and grams, we get an intrinsic value of $85.99. Applying a 15% margin of safety, you get an intrinsic value of a settled buy price, sorry, of $73. Now, this is well below the current price of $126. And I know a lot of people will just say, yeah, but what if Nvidia achieves 20%, 30% growth rate for, I don't know, 10 years of free cash flow? But what people do not understand is that if they reach 30% free cash flow growth rate, that is literally what they are priced for. So they are meant to do that. If they do less than that, then their price will decrease because they will not meet expectations. And do you really think a company that grows 30% per year for 10 years will really have that much room to grow in 10 years? I mean, where do you get your upside here? What return do you get on this investment? I just cannot see the potential here. And also, they cannot really have a 20 or 40% CAGR because capex in these huge US tech companies is already at 50 to 60% operating cash flow. How much can you really grow it? I mean, there is a limit to all of this capex that is going into NVIDIA's free cash flow. Yeah, I don't think they're at a great price. If they drop to $70, then yeah, they're a buy. But at today's price, I do not believe there is much potential here. So yeah, as we finished with NVIDIA, now let's do Salesforce. It's the next company on our list. Salesforce, if you don't know, is an American cloud-based software company. It provides applications focused on sales, customer service, marketing automation, e-commerce, analytics, artificial intelligence, and application development. Their balance sheet is pretty good, so 1.1 current ratio. They can meet their short-term needs adequately. Their ROIC is 5.6, so a bit low, and their ROE is 7%, also a bit low, but nothing to worry about yet. Their free cash flow yield is 3.5%, so this is a bit much better than NVIDIA. It's not high enough. It is still a price evaluation, but it's not comparable to NVIDIA. And their price to earnings is 50. Next, let's do Graham's valuation. 1 second, I need to find their. So it is 0.02. Okay, and we get the next intrinsic value of $235, a bit below the current price. Discounted cash flow. Well, let's see here. They've grown at an average of 33%, and I believe that looking at their next 2 years growth rate and extrapolating over the next 10 years, 9 years, sorry, I think we can get an acceptable growth rate of somewhere between 10 and 15%. I actually think it's closer to 10.5 because or 11%, something like that. It's hard to believe that they can actually do 15% for 9 more years. If you believe they can do more, then their DCF price per share is above the current price, so they are a buy according to the DCF, but I'll just stick to 11%. It seems much more plausible, in my opinion. So the DCF price per share is very similar to the current price. Historical multiples, yeah, these are insane, and also they've had a few years of loss and then very low earnings because when you go from unprofitable to profitable, your earnings are very low for a short period of time, thus making your PEs very high. So this artificially inflates their price to earnings. So we just skip it, and the multiple valuation model. Well, um, I'll skip it as well because it also takes into account historical multiples and comparable multiples, and there is no point in only using comparable multiples. The dividend discount model, they don't give out, they've only given out a dividend this year, so it is hard to say how much it will increase. Their payout ratio is not calculated, 1.6 dividend, but well, it's pretty small, dividend yield of 0.52%. I think they can grow at, I don't know, I think 10% is a good growth rate for their dividend. So a 251 valuation is what we get. Now we'll just remove the multiples and we'll add in the dividend discount model and the intrinsic value of $259. Applying a 15% margin of safety, we get an acceptable buy price of $220.5. Well, I believe that, of course, they are overvalued. Not as much as Nvidia, but of course, but still pretty overvalued. So I do not think they're a buy. Also, take to make a small mention is that to make a small note, sorry, is that their balance sheet is definitely not as good as Nvidia's, and their business metrics are not even comparable. They're in two different leagues. Uh, the thing is, Salesforce is a bit more diversified than Nvidia in their portfolio of products and services. So this is an advantage, but it's not like Nvidia will just go bankrupt overnight or lose their technical advantage. It is impossible. To be honest, I do not believe that AMD will ever overtake them unless Nvidia's management becomes incompetent. But I don't think it will happen with Jensen Huang at the helm. Maybe China someday manages to improve their technology enough to overtake the United States. But for now, Nvidia is a leader, so their valuation is warranted in the sense that they have a huge moat. Salesforce, on the other hand, although less overvalued, does not have that much of a moat as NVIDIA, and also, if I might add, their balance sheet, their business metrics are not necessarily excellent. Yeah, this is a okay stock, but as I've been trying to say, they're not trading at a good price. If you get it at 200 to 10 to 20, even lower, that would be perfect. But for now, this is overvalued. And this is just my opinion. Of course, do your own due diligence because it is very important to invest only with facts and not just opinions that you see on the internet. You have to keep this in mind. Yeah, the To finish our video, I'll talk a bit about our affiliate for today, Ticker Data. Ticker Data is the tool that I use today. So you just plug in a ticker symbol here and you get all of this great data, all of this. You can use the DCF model, multiples model, DDM model, and actually have other templates that are specifically focused on this. So this is one of many templates. The greatest thing about ticker data, the thing I like most, is the fact that you can plug in any ticker symbol, any recent financial year, fiscal year, and you just get all of the data in a few seconds. So this is a great tool. Also, do not forget to check out my investing blog from the link in the description below, where I feature in-depth analysis on stocks, and also soon I'll publish an interesting article about the current stock market valuation. And yeah, this has been it for today. I hope to see you in the next video, and bye.